Of accrual accounting. It's a critical idea. We talked previously about what GAAP is, generally accepted accounting principles. Generally accepted accounting principles are the accounting rules that everybody uses. The idea of accrual accounting is a key part. Where's the attendance sheet? Is it right here? Okay. It's a key accrual accounting. The idea of accrual accounting is that you don't necessarily record revenues when you get the money, and you don't necessarily record expenses when you pay for them. But rather you record revenues when they're earned. That's going to be rule number 2. And you record expenses usually when you get the benefit from those expenses. And we're going to talk about that today. So what the accrual system does is it delivers a different measure of net income that supposedly is going to be more useful for investors. So GAAP requires this accrual method be used following these 2 basic rules. Let's go through the rules. The first is called the revenue recognition principle. Revenue recognition principle says that you record revenue when it's earned and received or receivable. So for example, what is the difference? The difference is that if the company earns the income, it doesn't necessarily get paid immediately. For example, you might come to my store and buy a shirt. And you're going to pay me next week. Did I make the sale today or did I make the sale next week? Next week?
You made the sale today.
The sale today or next week? Why do you say today?
You sold it today.
But I'm not going to collect the money till next week. What if you don't pay me? I didn't make any sale then, right? And why do you say next week then? Because that's when I receive the money. And you want to be extra careful not to record any sales by accident. So how do you know you're not going to, how do I know I'm going to collect the money? So the FASB says is that there's certain things you have to do to earn the sale. And if you've done those things and you're pretty sure you're going to collect the money, you got a sale. So if I sell you a shirt today and we agree you're going to pay me next week, and I know that you're good for it, sale. If you agree you're going to pay me next year, it's still a sale, as long as I reasonably expect to collect that money. So a revenue is recorded when it is earned. Now that's for products. When we're talking about products, physical products, it's going to be whenever I deliver the product to you. But what about services? So let's say I mow your lawn, and we have a deal. Every week I mow your lawn for $20. When do I record that revenue? When have I earned that revenue? How do I earn that revenue? When I provide the service. So when I mow the lawn, I earn $20. Every time I mow the lawn for you every week is another $20 of revenue earned. And that's how earning revenue works. Now, you could say, but what if the customer pays me at the end of every month? So I have to wait till the end of the month to record revenue? No. As long as I reasonably expect to get paid, then it's perfectly fine to record the revenue now. What if it's not reasonably expected to get paid? Then why am I mowing the lawn? Right? Why would I do it if I didn't expect that you were going to pay me? Now there are businesses like that, by the way, where the sale isn't recorded until you collect the money, but we're not going to get into that today. That's the idea of revenue recognition. So let's try it out. On December 1st, year 1, a retail store, I can make this bigger so it's easier to see on the screen. A retail store sells a $1,500 computer. Nancy pays $500 in cash, signs an agreement for the remaining $1,000 to be paid next year. In year 2, on the income statement, how much revenue should be recognized in year 1? Based on this revenue recognition principle. 500? $1,500, the whole thing. And how much in year 2? 0. Now this begs the question, what question are you thinking? You're thinking, I know what question you're thinking. When is he going to break? What if she doesn't pay? We'll deal with that. Don't worry about it. Next question. Next thing though. Gap 3, the matching principle. This is my favorite. I really like the matching principle. I don't know why. I just do. The idea of the matching principle is that, and I mentioned this before, there's a cause-effect relationship between expenses and revenues. That an expense should cause a revenue to occur. It's a natural connection. And if you say, huh? Shouldn't revenues cause expenses? No, it goes the other way around. Expenses cause revenues to occur. I'll explain. Like, let's take this class, right? Seton Hall pays me, and because it pays me to teach the class, you all come to the class and pay tuition. So because of the salary expense, tuition revenue comes in. What if Seton Hall decided we're not going to pay our professors? There's no tuition, right? Because you're not going to get any students to pay tuition if there are no classes being taught by professors. Actually, some students might prefer that. So there's a natural connection. And then why would a company pay for expenses if it wasn't going to bring in revenue? That would just be a waste of money. Right? Why have an expense that is... Now, you might take a risk sometimes, right? And you might put an advertisement in a certain magazine, not sure if it's going to increase sales or not. Right? Sometimes you might take a little risk and spend money on something if you're not sure if it's going to bring in revenue or not. And that's okay. But the general expectation is that if you spend money on an expense, then it's going to bring in a revenue. Now, this is different from a loss. A loss does not bring in revenue. What's an example of a loss? Your pizza delivery driver crashes the truck into a tree on the way to pizza delivery. Now, would you say to the pizza delivery, okay, we want to increase revenue, so spend more, let's waste money today and crash your truck into a tree? Right? You'll pay the delivery person because they deliver the pizza and that brings in revenue. But you will not intentionally crash the truck into the tree. That's a loss, because that's not going to increase revenue. So losses generally happen when you have no control over a situation. That's perfectly okay, sometimes it happens. But that's why a loss is very different from an expense. A loss costs you money, but it doesn't bring in revenue, whereas an expense does bring in revenue. By the way, another thing, losses are usually non-operating. Expenses are usually operating. So, now, a situation come up where you usually record expenses when you get the benefit from those expenses. So, for example, cost of goods sold. Let's say I buy a book, I'm the bookstore, and I buy a book in 2013. I buy the book. In 2014, I sell the book to a customer, and in 2015, I pay for the book. I pay my supplier for the book. So 2013, I buy the book from my supplier. 2014, I sell it to my customer, and 2015, I pay for it. When would you record the expense? First of all, when do you record the sale? 2014. The next question, when do you record the expense? You record it in the same period of the sale. Because you can relate, you can say the cost of the book. The only reason why you bought the book in the first place was to sell it. So you're going to match the expense to the revenue, and therefore the cost of goods sold is going to be recorded in the same period as the sale. 2014. Even though you bought the book in 2013, even though you're going to pay for the book in 2015, because the book was purchased in order to be sold in 2014, you're going to record the revenue and the cost of goods sold in the same period. And you're not going to record any cost of goods sold in 2013 or 2015. Now, if you can't find an association like that, that's the principle behind cost of goods sold and commissions. Let's say sales commissions. Always record sales commissions in the same period that you make the sale. Sales commission expense, sales revenue, they go together very nicely, right? Some expenses aren't so simple, like advertising. When you put an advertisement in the newspaper, when is you're going to receive revenues from that advertisement? Maybe now, maybe later, right? Someone sees the advertising like, that's a good idea. Maybe I'll buy a nice shirt like that. And then next year they buy the shirt. So there, the cause and effect is not so clear. So you record that expense when it happens. And there may be other approaches also, like depreciation. Try this out now. In this accounting period, Cycles Galore bought 10 bikes for $200 each at wholesale and sold 6 bikes for $500 each to customers. On the income statement, how much will be reported for each item? Let's go through this together. How much sales revenue did the company have? $3,000. And how did you get that? That is 6 bikes at $500. Okay, cost of goods sold. What is your cost of goods sold here?
10 times 260.
Wait, how many bikes did you sell?
Oh, 6.
You sold 6 bikes, right? So you're only going to record cost of goods sold for the ones that you sold. So cost of goods sold here would be $1,200. That would be 6 bikes. You don't record cost of goods sold for the bikes you didn't sell at $200 each. And therefore, a gross profit would be what? $1,800. What happens to the 4 unsold bikes?
They go into inventory.
Yeah, they're part of inventory. And where does inventory go? Balance sheet, income statement, retained earnings, cash flow statement. Balance sheet. And how much, oh, this is a good question. And how much will they be reported on the balance sheet at? $800, that's good. That's $800. How did I get that? That would be equal to 4 bikes at $200 each. So what I'm also going to do for you guys is, just so you know, I'm going to post some old exams. I got to find them, but I'll post some old exams so you can use to study. Now, let's look at this more comprehensively. Just focus on the accrual column for a second. Kiger Kayaking began operations August 1st with the following transactions during the first month of operation. I think 2 years ago we asked this on the test. This is a brutal question. Paid August office rent of $4,000. Is that going to be an expense in August? Yeah, that's a legitimate expense. So I'm going to write it here in parentheses. Purchased and paid $32,000. Don't worry about the cash column. Purchased and paid $32,000 for merchandise inventory. Is that an expense? Yes? No? How many say it's an expense? How many say it is not? Okay, not everybody voted, and this is a totalitarian country, and there's a death penalty for not voting, like in Syria. So, how many people here say it's an expense? And how many people here say it's not an expense? It's not an expense. You didn't sell them yet. It's inventory. It's an asset. So it's 0. Sold merchandise for $54,000 to customers at retail that costs $20,000 wholesale. So first of all, what's your revenue here? $54,000. And is there an expense? Yes. How much? $20,000. That's cost of goods sold. Received and paid a $1,500 advertising bill for August, September, and October. This is very tricky. In other words, this is for advertisements that are going to run in August, September, and October, and assume that it's 1/3 each. David.
You pay just 500?
Yeah, but no, you're not paying. Let's not talk about paid.
I mean,
We're talking about expense. How much of this is an expense in August? 500 is an expense in August. Paid September office rent of 4,000. Is that an expense in August? Yes, no, not sure? No, absolutely not. So therefore we have minus 4,000 plus 54,000 minus 20,000 minus 500 is $47,500. Now let's look at cash for a second. Cash, think about how these transactions impact cash. Paid office rent of $4,000. Does that affect cash? How? That is a $4,000 cash outlay.
wait, how is that 47,000? Won't that be
Huh?
For the August, for the accrual, like, at the very bottom,
It doesn't add?
no?
wouldn't that be 29,500?
Yeah.
Minus 4,000 plus 54,000 minus 20,000
500.
minus 500 is, 29,500. I hope the new Apple OS has calculators that work. 29,500. Thank you for correcting me. Thank you so much. It's got my back. Purchase and paid $32,000 for merchandise inventory. Is that cash payment? Yeah, so we're going to pay out $32,000 in cash. Sold merchandise for customers for a retail that costs $20,000 wholesale. Received the cash from customers. What happened to cash? We received how much? 54,000. Now, did we pay 20,000? No, because on August 5th, that's when we paid for the merchandise. Getting excited now. Received and paid a $1,500 advertising bill for August, September, and October. How much money did I pay? $1,500. So I'm going to subtract $1,500 cash. Look at how different accrual is from cash flow. Isn't this exciting? Paid September office rent for $4,000. Yeah, cash went down by $4,000. So now, and you can double check me to make sure that my math is good. Minus 4,000 minus 32,000 plus 54,000 minus 1,500 minus 4,000 equals 12,500. Cash increased by 12,400. Yes? No?